Welcome to the fourth episode of the Building a Winning Trading Strategy Step-by-Step series, the only series on YouTube that will actually help you take the next step you need in your career as a trader. My name is AlgoTrade Pro and I will show you all the secrets that professional traders use to create their trading strategies. Let's go! Finally, in today's episode, I'm going to reveal the last piece of our strategy. As you have already seen from the title, today we are going to discuss an indicator that may seem unimportant, but which will be essential to increase the net profit of our strategy, which is called the exit indicator. Before that, if you don't know what I'm talking about, pause this video and start watching the series from the beginning to catch up on everything. The link to this series is in the description. Before jumping into the exit indicator, I will just do a quick recap of what we already know that I'm going to use in my strategy. Therefore, my strategy will be for the 2-hour time frame. I will apply it in the cryptocurrency market, and for now, these are the cryptos that I chose to carry out the backtests. My risk management will be done using the ATR indicator with the default settings. My confirmation indicator, which is the indicator that provides the entry signals, will be the Ep.4 with the settings 14, 5 and 4.238. My filter indicator, which is the indicator that eliminates false entry signals from the QQE, is the untrend price DPO with a period of 21. And my volume indicator that protects me from entering in a sideways market will be the Water explosion with the settings 110, 20, 40, 20 and 2. I know it may seem like a lot, but believe that in the end it will all make sense. And I will show you all the real results of this strategy. In addition to that, stay tuned because you will have the opportunity to access this 100% automated strategy to use it wherever you want. As such, I believe you will not want to miss this lifetime opportunity. So, don't forget to subscribe to the channel and turn on the notifications to be alerted as soon as I make this strategy available to you. You can also join our official Discord group because it's free and there you will be informed of all the news in advance. So, for now, we would close a position if our take profit 1 or trailing stop loss was activated, if the stop loss was hit, and also if our confirmation indicator gave an opposite signal during an open trade. Now, in addition to these three conditions, we will also exit a trade when the exit indicator says so. An exit indicator is an indicator that is used to verify the best time to exit a trade. It is used to reduce losses, maximize profits and manage risk by providing a signal to close a position when certain criteria are met. Usually, an exit indicator is a momentum or trend indicator that is faster than our confirmation indicator, which gives us information about the short-term trend. I will give you a simple example. So here we have our strategy at the moment. For a short position, the Ep.4 has to give a sell signal, so when the green line crosses under the red one, the untrend price DPO line has to be under the zero level, and the Water explosion volume bar has to be above the yellow moving average. For the risk management, you already know that the stop loss is equal to 1.5 times the ATR pip value, and our take profit 1 is on the 1 times ATR pip value level. So, in this example, on the Bitcoin chart, our take profit 1 was hit here, so the bot would close 50% of the position, and then it will apply the trailing stop loss for the second 50% of the trade, which you already know that is always 1.5 times the ATR pip value behind the price. And as you can see, the trailing stop loss would have been hit here on the 1 to 1.3 risk reward zone. But what if we use the relative vigor index as our exit indicator? Will the results be the same? Let's insert that exit indicator to find out. So, as you can see, the relative vigor index is very similar to the Ep.4 indicator, but its signals are faster. It wouldn't be a good confirmation indicator, but maybe it could be a good exit indicator. As you can see, when we entered the trade, the relative vigor index already showed signs of a bearish trend. But keep in mind that for a valid entry signal, the information from an exit indicator has no use to us. The trade unfolded, reached the take profit 1, and until that moment the relative vigor index maintained its bearish trend. But before the trailing stop loss was activated, this exit indicator gave a long signal. The green line crossed above the red one, which will be our alert for exit the trade. As such, we will exit the trade after this signal is confirmed, therefore at the close of this candle. And as you can see, in this way, the second half of the trade will be closed in the zone greater than the 1 to 2 risk to reward ratio. And the same applies to trades that will be a stop loss. An exit indicator has the power to close them before the stop loss is reached, thus reducing the losses of our strategy. In this example, without an exit indicator, we would close the position here, due to the fact that our confirmation indicator flipped. It would not be a case of a complete stop loss, but it would still be a losing trade. But by re-entering the relative vigor index, we can see that we would exit the same trade at this point when this exit indicator gave us a short warning. And as such, this losing trade will turn into a trade with a slight profit. Have in mind that I only showed you 2 examples with the relative vigor index, and examples that were chosen in order to give you a good example of how an exit indicator works. It does not mean that this is the best exit indicator for our strategy. We will have to do a bigger backtest to find out. As such, an exit indicator will, in practice, decrease the average loss of our strategy, thus increasing our average risk to reward ratio. It will decrease the swap commissions paid to the broker, and it will decrease the drawdown of the strategy while increasing the net profit. We may see a slight decrease in the strategy's win rate, but that won't be a problem, because the strategy's efficiency will increase. And how do you know which one is the best for your strategy? It's quite simple. Again, we just have to backtest as many exit indicators as possible, and the selection process is exactly the same as the one used in the other episodes. We will do a lot of backtests on our in-sample data, where we will choose the 2 or 3 best exit indicators that increase the net profit of our system the most, while decreasing the average drawdown to carry out the backtests on the hour of sample data. After that, we will know which is the most consistent and if it is necessary to carry out some kind of optimization. If you don't remember how I carry out this analysis, go back to the first episode of this series, because I explained everything in detail there. So, as usual, I'm going to do all these backtests to choose my exit indicator, and I will show you the whole process. The first backtest will be in the in-sample data. Let's go! Here are all the results of my in-sample backtests. Nice. As you could see through some clips I was showing, I used my backtesting bot to help me, but everything I did you can also do manually. I tested 20 different exit indicators and put them in this table to compare them. Here there is no specific number of indicators to test. But the more you test, the better, as you increase the probability of finding good indicators. As you can see, no exit indicator got great results in this first backtest. Of course, this is not a negative thing. We have 3 options at this moment. Either we carry out more backtests on different indicators to try to find an exit indicator that has more impact on the efficiency of the strategy, but this can be more time consuming, or we try different settings on these 20 indicators, but in this case we need to be careful to not overfit the strategy, or we can choose the best ones and proceed to the backtest on the hour of sample data, which is what I'm going to do. Therefore, we can see that the tricks indicator was the only one that decreased the average drawdown of the strategy, and the parabolic SAR was the one that maintained the stats fairly the same. All other indicators had very sharp drops in the win rate and net profit of the strategy, and none of them also managed to lower the average drawdown, and so, for that reason, they are not worth using. Of course, note that depending on the change in the sample, risk management, timeframes or markets, the performance of these exit indicators can change completely. So, don't be guided by my results if you are going to create a strategy different from mine. Now, to find which one out of these two exit indicators is the most consistent, I'm going to apply them to my out of sample data. I will do it again using my backtesting bot, and I will be right back. And here we have the results of both samples of the two best tested exit indicators side by side. As I mentioned in the other episodes, the difference between samples should not be greater than 15 to 20%. And, by that way, you can see that both exit indicators respect that rule. But, regarding the improvement of stats, which is what we are actually looking for with the use of an exit indicator, we can see that the parabolic SAR does not improve any of them. Comparing the strategy that uses the parabolic SAR as an exit indicator with the strategy that does not have an exit indicator, we can see that the net profit decreases as well as the win rate and the average drawdown increase, so the parabolic SAR is eliminated. Regarding the tricks, we can see that the average drawdown decreases slightly, and therefore we can continue working on this exit indicator. As such, I will now move on to the optimization phase of the tricks exit indicator to try to find settings that work best for my strategy. I will carry out a lot of backtests with different settings on my in-sample data, and I will be right back to show you the results. So, as you can see, the results didn't change much, and there weren't any more efficient settings than the ones I used in the first backtest. Despite this exit indicator not having made a big difference, at least in these three statistical aspects, I will now create the Excel with all the trades of the strategy from both samples so that we can analyze in detail all the statistical data. If you want to know how I create these Excels, go see the second episode of the series, because there I explained everything in detail. Now I'm going to do the new Excel and I will be right back.
A few minutes later.
And here it is. This is all the statistical information about the updated strategy that uses the tricks indicator as an exit indicator. The application conditions were exactly the same as the ones used in the last episode. A 2% risk per signal in a bankroll with $10,000. I remind you that I'm not yet considering commissions and swaps, which will only be done in the final episode. In order to better understand the variations that this exit indicator makes in my strategy, I will compare each statistical value with the values presented in the third episode. So, on this side, I have the sheet with the data from the QQE Ep.4 plus the untrend price DPO and Water explosion indicators with the respective settings. And on this side I have the sheet with the same indicators plus the tricks indicator. Firstly, we can see that the equity curve continues to be pretty consistent. Regarding the win rate, as I told you, it decreased a little bit from 60.7% to 58.4%, which is typical when using an exit indicator. Regarding the average annual net profit, it decreased just by 6%. The number of trades stayed identical as expected because the exit indicator doesn't filter entry signals. Regarding the average risk-to-reward ratio, it improved from 0.89 to 1, and the profit factor improved by 0.01. So we can say that it stayed the same. So until now, we can see that the changes made by this exit indicator are not very good. But let's continue the statistical analysis. Regarding the max drawdown, it decreased from 46.25 to 41.28, and the average drawdown also decreased from 9.25 to 9%. So a good improvement here. And finally, the Sharpe ratio increased as well as the return over max drawdown ratio, which now is practically 4, which is very good. I will be honest with you, when analyzing the first metrics, I thought that this exit indicator was not going to be included in the strategy. But the increase in the Sharpe ratio and mainly in the return over max drawdown ratio showed that after all, this exit indicator still had some impact on the efficiency and consistency of the strategy. Still, I think we can find a better exit indicator in the future. I will work on it. But for now, the tricks indicator with these settings will be our exit indicator. For those who will have access to this Excel, I will leave this sheet here where we will be able to carry out Monte Carlo simulations automatically. To find out how you can access this Excel and many others, check the links in the description. So now our strategy is ready. We have all the technical pieces together and working properly. But there are still some important tests we must do before putting this strategy in action in a real trading account. Next week you will find out what tests these are. So don't forget to subscribe to my channel and turn on the notifications so you don't miss any episodes. I hope you enjoyed it and above all that you learned something new, and I wish the best of luck to those who are going to start their backtests on exit indicators. If you want to speed up that process, you can access my backtesting bots, which can backtest thousands of trades in a few seconds. For more information, check the links in the description. And that's it for today. Don't forget to subscribe, comment, share and like this video to support me in bringing more content to you. Be well, thank you, bye bye.